So glad that you're back. We're more than midway through this course, so hang in there because the end is near. We now shift our focus to some of the major accounts, starting with inventory. Comparing the performance of companies can be challenging because of the allowable choices for valuing inventories. Thankfully, there are standards in place to ensure that all companies use the same inventory valuation methods. In this first part, we shall learn the standards in which inventory should be accounted for. We start with the inventory equation, followed by understanding what the costs are that should be capitalized and what should be expensed. We end off with learning how inventory adjustments should be affected if the valuations of the inventory fall below cost. Let's get started. Merchandising and manufacturing firms generate revenues and profits through the sale of inventory. Merchandising firms like retailers and wholesalers purchase inventory that is ready for sale, often reported in just one account as inventory on the balance sheet. Manufacturing firms, on the other hand, report inventory using three separate accounts: raw materials, work in process, and finished goods. Taking a simple one-account approach, the inventory account starts the accounting period with the beginning inventory. Throughout the course of the accounting period, new purchases would have been made. This adds to the inventory account. At the same time, inventory would have been sold to customers. The cost of these inventory have to be subtracted from the inventory account. This gives us the inventory equation. We can rearrange this equation in any way to enable us to find any of the unknowns. In the course of building up inventory, there are several costs that may have been incurred. Which of these costs should be capitalized as inventory on the balance sheet as part of the purchase cost? And which of these should be expensed as operating expenses in the income statement? Both IFRS and US GAAP are clear on this. The purchase cost of the inventory, less trade discounts and rebates, conversion or manufacturing costs, including labor and overhead, and any other costs necessary to bring the inventory to its present location are known as production costs. All these should be capitalized as an asset in the balance sheet. The expense recognition is delayed until the inventory is sold and revenue is recognized. Abnormal waste of materials, labor or overhead, storage costs, admin overhead, and selling costs are considered period costs. All these are to be expensed in the period they are incurred. Let's go through an example. A sofa manufacturer produced 1,000 units of a sofa last year. The costs incurred for the manufacture of these 1,000 units are listed here. Assuming that no abnormal waste is included in manufacturing overhead, compute the capitalized cost per unit of sofa produced. Pause the video now to work out your answer. And we're back. Under IFRS and US GAAP, the costs that can be capitalized are the purchase costs, conversion costs, and delivery costs. The purchase of raw materials to manufacture the goods should be capitalized under purchase costs. Direct labor and manufacturing overhead are considered conversion costs, the costs incurred to convert the raw material into finished goods. Freight to plant should be considered under delivery or other costs. Note that only costs incurred to bring the inventory in place can be capitalized. Delivery costs to customers should be expensed. Adding up all the items, the total cost to be capitalized is $217,700. The rest of the costs should be expensed. Dividing the total cost by 1,000 units, we get capitalized cost per unit of $217.70. Now that we know how to capitalize inventory cost, you may be wondering, does this item remain recorded at this value in the inventory until it is sold? The answer is no. Both IFRS and US GAAP allow for the revaluation of the inventory value. Under IFRS, inventory value is reported at the lower of cost or net realizable value. This means that if the net realizable value falls below the cost, the inventory should be written down to the net realizable value. The net realizable value is the estimated selling price less estimated cost of completion and less selling cost. For instance, a car manufacturer may have an unfinished car that has a capitalized cost of $3,000 sitting in its inventory. Say the estimated selling price of the car has fallen to just $4,000 due to intense competition from other manufacturers. The company estimates that another $800 cost is needed to complete the car for sale. Another $500 cost is needed to sell the car. The net realizable value of this car is now just $2,700. Under IFRS, the manufacturer needs to write down the inventory value of this car by $300 to get its net realizable value. This $300 loss is recognized in the income statement. Reversal of write-down is allowed under IFRS. If the market recovers such that the car can be reasonably sold at $5,000, the inventory value can be revalued back to the $3,000 cost. In the income statement, the cost of goods sold is reduced by $300 to reflect this revaluation. Under US GAAP, inventory value is reported at the lower of cost or market. The market is equal to the replacement cost, but cannot exceed the net realizable value or be less than the net realizable value minus a normal profit margin. If the replacement cost exceeds the upper bound, then market is NRV. If the replacement cost is less than the lower bound, then market is the NRV less profit margin. If the market is lower than cost, then the inventory has to be written down to market. Unlike IFRS, reversal of write-downs is not allowed under US GAAP. Back to our example. We've earlier determined that the NRV of the car is $2,700. Let's say the replacement cost of the car is $2,500 and the normal profit margin is $300. What we first need to do is to determine if the replacement cost falls within the range of NRV and NRV minus normal profit margin. Since the normal profit margin is given as $300, we know that the replacement cost falls into the range. The market is therefore equal to the replacement cost, which is $2,500. Since market is less than the cost, which is recorded at $3,000, we need to write down the inventory value by $500 to $2,500. The write-off is recorded as a loss in the income statement. The balance sheet value for the car is reduced to $2,500. Remember, even if the market price recovers in the future, reversals of write-downs are not allowed under US GAAP. A write-down of inventory to NRV or market affects the financial statements and ratios in several ways. As inventory is part of current assets, an inventory write-down decreases both current and total assets in the balance sheet. Equity is decreased due to the reduction in retained earnings. In the income statement, the increase in cost of goods sold as a result of the write-down decreases the gross profit, operating profit, and net income. All these changes affect the ratios in different ways. The current ratio decreases as the current assets decrease. However, the quick ratio and cash ratio are unaffected because inventories are not included in the numerator. Inventory turnover is increased as the cost of goods sold increases and average inventory decreases. This decreases the days of inventory on hand and subsequently the cash conversion cycle. The decrease in total assets increases total asset turnover. The debt-to-assets ratio is also increased due to the reduction in average total assets. The decrease in total equity causes the debt-to-equity ratio to increase. The decrease in profits reduces gross margin, operating margin, and net margin. The percentage decrease in net income can be expected to be greater than the percentage decrease in assets or equity. As a result, both ROA and ROE are decreased. For periods subsequent to a write-down of inventory, cost of goods sold may be decreased by lower inventory carrying values. This means that profits may increase in subsequent periods. Together with the decreases in assets and equity from the prior period write-down, this increase in net income will increase reported ROA and ROE in subsequent periods. That concludes this first part on inventories, where we learn how to account for inventory in the balance sheet. In the next lesson, we shall learn the methods to account for the cost of the inventory that was sold. See you at the next lesson.